The topic of this video will be $1,000 par value first mortgage bonds that can be bought in the bond market. I discussed in my prior video $25 par value first mortgage bonds that trade like stocks. The universe of first mortgage bonds issued by operating subsidiaries of utility holding companies that have $1,000 par values is much larger. These bonds have make-whole provisions that protect the bondholders from the interest rate risk related to a decline in interest rates below the existing coupon. That provision requires the bond issuer to pay more than par value as a penalty for exercising an optional redemption right prior to the bond's maturity. The make-whole provision is irrelevant when the issuer cannot refinance at a lower rate than the existing coupon due to a rise in interest rates. The bond owner still faces that interest rate risk that would result in the bond price moving lower. The make-whole provision comes into play when rates have declined sufficiently that it would be in the issuer's interest to redeem, but not in the bond owner's interest, who does not want to receive a bond's par value that cannot be reinvested at the same current yield or yield to maturity due to the interest rate decline. Generally, this make-whole provision says something like this. The issuer has to pay the greater of par value plus accrued interest, or the sum of all interest payments to maturity and the principal amount, discounted to present value, using the yield of a comparable treasury plus some percentage that might be somewhere between 0.1 to 0.5%. And discounting generally occurs semi-annually, which is how the bond payments are made. It could be quarterly if the interest payments are made quarterly. If interest rates are low, as they were for many years prior to 2022, the discounting to present value leaves more in the sum total than when interest rates are higher than the coupon, as many are now. Think of a 10-year corporate bond with a 5% coupon, but the issuer could refinance at year 5 at 2%. Say the 5-year treasury is at 1.2%. The sum is discounted by that treasury yield plus maybe a small increase of 0.1 or 0.2, which would result in a very slow discounting to present value and a much higher amount that the issuer would have to pay over par value to redeem the bond. This basically protects the bond owner from an early redemption. If the issuer exercises the early redemption right at a time when interest rates have declined, the owner receives a premium payment to par value as compensation for losing the bond. When buying a $1,000 par value bond, in order to buy one would be for a $1,000 par value bond, the pricing is at 1/10. So in order to buy one at 90 would cost $900 plus the brokerage commission, which is $1 per bond at Fidelity and Vanguard, plus accrued and unpaid interest up to that date. If an investor owns a relatively high coupon bond, when interest rates decline substantially, the value of a bond protected by the make-whole provision from an early call will go up. And many of those sold for 130 or 140 or higher when interest rates dive to historical lows during the Fed's jihad against the saving class. That can obviously create a profit potential if the owner is willing to forgo the interest payments in exchange for selling the bond at a profit. That is not the case with a high coupon exchange traded bond that I talked about earlier in a prior video that is no longer protected by 5-year call protection from the time of issuance, or is anywhere close to losing that call protection, since the issuer will redeem the bond, refinance at a lower rate, and pay the owner the $25 par value. So in those kind of cases, the price of the exchange traded bond will be near par value. Some operating utilities that have first mortgage bonds, and I just compiled a partial list, include Public Service of Colorado, Southwestern Public Service, and Northern States Power that are subsidiaries of XL. XEL is the stock symbol. Entergy Arkansas, Entergy Louisiana, Entergy Mississippi, and Entergy Texas, operating subsidiaries of Entergy. Duke Energy Florida, Duke Energy Indiana, subsidiaries of Duke Energy. Commonwealth Edison, Atlantic City Electric, and Potomac Electric Power, operating subsidiaries of Exelon. The stock symbol there is EXC. Ameren, Illinois, operating subsidiary of Ameren. The stock symbol is AEE. Consumers Energy, subsidiary of CMS Energy. DT Electric, subsidiary of DT Energy. Evergy, Metro, and Evergy, Kansas, subsidiaries of Evergy. Symbol is EVRG. Louisville Gas and Electric, subsidiary of PPL. Public Service of Electric and Gas, a subsidiary of Public Service Enterprise. Symbol there, stock symbol is PEG. Public Service of New Hampshire and Connecticut Light and Power, subsidiaries of Eversource Energy. Stock symbol is ES. I will have several first mortgage $1,000 par value bonds maturing this year, including those issued by Atlantic City Electric, Commonwealth Edison, Consumers Energy, Entergy Arkansas, Potomac Electric Power, Public Service Electric and Gas, and Southwestern Public Service. I will leave some CUSIP numbers of some of the bonds that I own that mature in 2025 to 2028 in the written section below.